We still have a few people joining, so we'll just give it one more minute and then we'll kick off. Again, thank you very much for waiting. Hi everyone, thank you very much for your patience in waiting. We seem to have most people in the webinar room now, so we're going to kick off. So I'd like to introduce Ian Milligan. He's our business development consultant at IQ & Co, and he's going to bring you through some tips to help find your tax relief, just with the tax year coming up. Thank you, and I'll pass across to you, Ian.
Thanks, Janine. Good morning, everyone. Welcome. Yes, we're going to just spend the next sort of 20-25 minutes max, really, just talking to you about how sort of smart planning and by using your allowances, your tax allowances can help to save you some tax. And let's face it, who doesn't want to save a bit of money and save a bit of tax? So hopefully you'll find something here that's of interest to you. So let me just sort of start off by talking about IQ & Co. Most of you will be familiar with IQ & Co, but just so you know, we're obviously a financial planning business that's right across the community in Northern Ireland. We're appointed representatives of St James's Place, and what that means is that they look after our compliance, they guarantee our advice, but most importantly for us and for you as well, it gives us access to some of the biggest and best fund managers in the world. IQ began as Mortgage IQ in 1999, and in the last 5 years, we've grown our financial planning business to have a substantial amount of money managed for our clients, 60 million. So we're growing rapidly, doing very well, and hopefully some of you are already clients of ours. We've 20 qualified advisors, lots of experience, and a very strong admin team, and 12 branches across the north. So that's just a bit on IQ. So let's get down to the real meat of things. Our advisors really are there, I suppose, to sit down with you and help you plan for your future, for your family, for your business, for all aspects of your financial life. And I think the quality of our advisors is something that really sets us apart at IQ, and we're very proud of our advisors. And they'll get to know you and really just look at what your objectives are. And really, you can see all the things there they can help you with in terms of your pensions and investing. We're going to talk about some of that today. But they can also help you with your business, with family protection, with business protection, and helping to look after protecting your income. One of the things that I would say is equally as important as building a plan is to make sure that that's regularly reviewed. And that's something our advisors are really good at doing with you, sitting down once a year, going through, checking and making sure that your plans are absolutely on track to achieve what it is that you want. So that's the role of the advisor. What we're going to specifically talk about today is tax. So tax planning is a really vitally important part of financial planning, as you can imagine. And what I would reinforce is how important it is to approach those things on a personal basis. Everybody's circumstances and tax liabilities are different and are individual. And that's why it's important to have a plan that's tailored to yourself. So we're all exposed to tax in different ways. We've all got different goals and aspirations. Some of you will be basic rate taxpayers, some higher rate taxpayers. Some of you may be fortunate enough to be additional rate taxpayers. But in my experience, I think the best approach is to just understand what your exposure to taxation is, and then really understand what reliefs and exemptions that you can avail of, and how you can use them effectively, and then build a plan and a strategy going forward to reduce your tax liability. And that's where we come in. That's where our advisors come in and tailor that plan specifically to you. So just looking at some of the specifics then of what you can do, you've got to be aware that not all of these things are available to you outside of the tax year. You've got to use them by the 5th of April, for example, this year. So time is of the essence. And there are some of these things that you need to think about. Can I do that before the end of the tax year? And so it might be important to sit down and make an appointment with someone quite quickly. So we haven't got long left, obviously, with the 5th of April being the end of this tax year and approaching. I'm going to start off by talking about ISAs, individual savings accounts, something that you'll be very familiar with. They've been around since 1999, and they've really just become a settled piece of the UK savings landscape, I suppose. Two main ISAs that we're going to talk about today are cash ISAs and stocks and shares ISAs. You do also have lifetime ISAs and innovative finance ISAs. Some of those are designed to help you get on the property ladder, etc. But say we're going to focus on cash and stocks and shares ISAs today. So many of you will have an ISA, but it's important to really think about what type of ISA that you have and whether the ISA that you hold is actually aligned to your savings goals and whether it's the correct one for you or not. So it's important to hold cash, but is a cash ISA the right place for your savings? It's really vital that you hold money short term for emergencies. But the problem is some people end up holding that short-term money long-term, and in which case it may have been better to actually invest that money because the potential for returns are much greater in an investment or stocks and shares ISA over the longer term. So it can be sometimes the case that people put money into an ISA intending to leave it there short term, but then it just carries on and carries on for a longer period of time. So I think it's important that you just sort of ask yourself these questions. Have you held your savings in your cash ISA for more than 5 years? Many people will have, in which case that might not have been the right choice for that money, because even though interest rates have risen, inflation has risen also, as we know. And are you giving your money the real potential to defeat and beat inflation, I suppose? I wonder, do you know what rate of interest you're actually getting on your cash ISA? And ask yourself, well, when was the last time I actually sat down and reviewed that with someone? So I'll highlight this as well. This is important. So we all have a personal savings allowance, which basically allows us to earn up to £1,000 of interest in cash if we're basic rate taxpayers. And if we're high rate taxpayers, it's up to £500. Anything over that amount of interest earned is going to be taxable. And that can be taxed via your tax code, and you might not even realize that that's what's happening. In this example that I'm looking at here, a basic rate taxpayer getting a rate of interest of just over 3%, 3.18%, could have £40,000 in cash that would earn £1,000 of interest, and anything over and above that 40,000 is going to start to incur a tax liability. So if you've more than that in cash, you're going to be paying tax. So it's so important that you use your ISA. Higher rate taxpayers, the same example and the same interest rate, anything above £500. And for additional rate taxpayers, there's no allowance. You're going to pay tax on all of the interest earned. So, I mean, some of you could be earning more than 3.18%, as this example shows, given today's interest rates. So it's very likely that you're going to be paying more tax. So the need to use your ISA allowance is vital. So really, you've a decision to make. I think as far as ISAs go, is it a cash ISA? Is it stocks and shares ISA? Stocks and shares is even a bit of an anomaly because you can, in fact, hold a stocks and shares ISA without even having any stocks and shares in it. We will build a portfolio tailored to you, and it may be that you want a stocks and shares ISA with no stocks and shares in it, and it would have an investment in things like property, in bonds, in government gilts, and it'll all come down to what your personal risk profile is and what you prefer. So yeah, without a doubt, longer term, I think stocks and shares ISA is the right choice. Cash ISA, good choice to save yourself tax on your interest, provided you don't intend to hold that over the longer period of time. So if you haven't utilized your ISA allowance this year, I would really encourage you to sit down with someone and think about that and plan. Whilst the 5th of April is the cutoff for the tax year, we would really be looking at applications on ISAs needing to be in by the 20th of March. So choose your ISA, choose the right one, and get some advice on that. Okay, outside of ISAs, for adults, there are also children's ISAs. Junior ISAs are a really good way of saving for your children and your grandchildren. Very tax efficient. Providing they're under 18, you can put up to £9,000 per year in, and it'll grow free of income tax and capital gains tax. So again, it's another allowance that you can utilize for your children. And really, I would encourage you to do that early. If you've opened a child trust fund for your children, you can now transfer that to a junior ISA. The longer it's in there, the better the opportunity there is for growth. So I would just really highlight that as something very important for saving for your children's future. And outside of ISAs entirely, there are other ways of investing tax efficiently. So whilst ISAs are the main tax efficient investment, unit trusts are also a tax efficient way of investing, because you can use your capital gains allowance and you will pay lower rates on any income taken from a unit trust, lower rates of tax. So that's another string to our bow that we can look at. If you have more money than you can put into an ISA, we would look at a unit trust for you. We can also invest in investment bonds, and that allows higher rate taxpayers to actually defer paying their higher rate tax. And it also allows you to plan for your future by appointing trustees to look after your investment bond in case anything were to happen to you in the future. And it allows them some flexibility around what they do with the money that you may decide to leave. Finally, pensions. I'm going to come on to pensions quite a bit, but I mean, I think people should really not get too hung up with how mystified pensions seem, because pensions are really just a tax efficient way of saving. They're really just an investment with a tax wrapper around it. And the government provides so many healthy tax reliefs and incentives on pensions in order for you to be more self-reliant and obviously less reliant on the government. And I'm going to come on to some of the things shortly that you can do with pensions, but they are such a tax efficient way of saving. So yeah, let's move on and talk about pensions for a bit. Retirement planning. I think we all understand the reasons for doing it, and the reasons for doing it are quite simple, as we're going to come on to. However, the challenge in doing it and doing it well and doing it right can be quite complex, and that's really where pension planning, I think it's vital that you speak to an advisor on and sit down with an advisor, and that's where our guys come in. So let's have a think about why retirement planning is so important. Over the last 40 years, life expectancy has rapidly increased to the point now where, you know, most men can expect to live to somewhere in around 79, and the average age for life expectancy for a woman is 83. So yeah, we all know the reasons for that. Obviously, better healthcare, better living conditions, and better working conditions. So a lot of us are going to be retired for quite some time, and hence the need to make provision for your retirement has really never been greater. So you've got some allowances there that the government provide for you with pensions. So what has happened is, though, that over the years, because of the pressure on the exchequer, those allowances have diminished. And having said that, in the last tax year, the Chancellor increased the amount that you can put into a pension every year. So the allowance for this year for most people is £60,000 into a pension. Based on your tax status, if you're an additional rate taxpayer, that reduces significantly, and you can see that it's down to 10,000 for additional rate taxpayers. So for most people, 60,000 into a pension. The good news is that if you've unused allowance from previous years, that can be carried forward, and that carry forward allowance applies for a number of years. So once you utilize your full allowance for this year, if you have a lot of money that you would like to invest and put into a pension, you could realistically put 180,000 into a pension in this tax year. And why would you do that? Well, I mean, the reason you would do it is pensions are probably the most tax efficient vehicle there is available for savings. There's money on the way in. There's tax relief on the way in. Sorry. So as you make contributions, you receive tax relief. And the HMRC actually add to your pension as you invest. Whilst it's there and whilst it's growing, you get tax relief. So it grows tax efficiently. And then when you come to lift your pension, you can take 25% of it tax free. So there's tax efficiency as the money goes in, tax efficiency while it's in, and tax efficiency when you come to take it out. So three real great benefits there. And in addition to that, you've got lots of reasons for putting money into a pension if you want to leave that money for your descendants, and it can be used to help plan for inheritance tax and allow your beneficiaries when they come to take the pension to lift the money tax efficiently. Okay, so lots of reasons for investing in a pension. As with junior ISAs, there is the opportunity to use some of your tax relief to actually start to put money into a children's pension. So the government have allowed 3,600 per year to go into pension every year for your children. It wouldn't actually cost you 3,600 because of the tax relief on the way in. As we spoke about, the net cost to you would be £2,880. So good way to create a nest egg for your children and a nice healthy return for your children or for your grandchildren, I must add as well. You can invest for them if you're a grandparent. All right, so we've really touched on the main sort of pillars of tax efficient investment, and those are really ISAs and pensions. I don't want to leave investing tax efficiently without mentioning venture capital trusts, VCTs, as you can see there, and enterprise investment schemes. Those are options for people who want to invest. They're a more risky strategy because what they invest in are smaller companies. Some of them might even be startup companies and new ventures, and they're right at the beginning of their growth cycle. So the government provide lots and lots of incentives to help those companies get started, because in future they may become large companies, employ lots of people, and contribute to the economy. So because the government want to encourage that, they provide a lot of great tax relief on those, but as I would say, they carry a higher level of investment risk. But just looking at some of the tax reliefs on those, you would have 30% tax relief on the money that you put in. And there's lots and lots of other benefits. The gains are free from capital gains tax. But without going into too much detail here, again, I would just encourage you, if those are things that really might interest you, I mean, whilst they're higher risk, the returns can also be extremely good as well. So yeah, I would encourage you to get in touch and sit down and talk to one of our advisors if that's something that you'd like to think about doing, but a very tax efficient way of investing. Okay, so before we finish today, I just want to touch on estate planning. This might be something that many people think is never going to come to them because inheritance tax is surely just for the very, very wealthy. Well, I think more and more people in the future are going to need to think about estate planning. It is becoming more prevalent for people because property prices have risen, estates have increased in value, and the government haven't really changed the allowances very much. So as a result, more and more people are going to have to think about that. It's really a tax that you shouldn't have to pay if you plan properly. There's no excuse for it. I'm just going to read you a quote from a previous chancellor. A previous chancellor basically said that he saw inheritance tax as a voluntary levy because it was paid by people who distrusted their heirs more than they disliked the inland revenue. So you'd have to really not like your family to not plan for the future and give them a big tax bill. And I don't think many people would hopefully fall into that category. So let me just talk to you about your allowances. So everyone has what's called a nil rate band, or an allowance of 325,000 on their estate, and that's going to stay like that until 2028. Anything above that is going to be taxed at 40%. So if you have an estate bigger than that, regardless of whether you're a basic rate or a high rate taxpayer, 40% is the tax on that. And you've got an additional allowance for your primary residence of 175,000. Now, good news is for married couples, that can be passed across on death. So if someone dies, their spouse would take their allowance, hence making the nil rate band for them 650,000. And you can also pass across your primary residence allowance, provided you've planned and decided to leave your main residence to your descendants. So in total, that would be 350,000, which added to the 650 means for a married couple, really you've got £1 million. But I just want to look at some examples of how people can easily fall into this trap. So take a single person who maybe has a nice property and it's worth 450,000. This is a single person, no children. They've got some savings there of 100,000, not a ridiculous amount of money, and they have an estate of 550,000. They haven't planned to leave their home to anyone. They don't have kids, so their only allowance is the nil rate band. So they're going to have a liable estate of 225,000, and if that's taxed at 40%, unfortunately, there's 90,000 going to the exchequer. So quite a lot of money to lose out of an estate. For a married couple, they have a much bigger allowance if they utilize it and plan. So by leaving their home to their descendants, they can avail of the nil rate band jointly and the primary residence allowance jointly, which means they have an allowance of £1 million. But they could easily have an estate above that if they had a nice family home, substantial savings, and maybe a nice holiday home on the North Coast. Even at that, they're going to have a liability on the amount over the £1 million, which in this case is 100,000, and they're going to give away £40,000 if they don't plan for the future. So just some small examples there of what can happen, and we can help people with their planning on that. So just going to talk to you about what types of things can be done. There are opportunities for small gifts. There are to various family members. You can give an annual gift away. You can give a gift on weddings. So there's lots of examples of things that can be done to reduce down the allowance. Some of these may be subject to a clawback period, but without getting into that too much, the main thing is to sit down with us. And if you do sit down with us, we'll go through quite a lot of options with you. One of which is to use trusts. So we can help build a trust for you. And what that does is allows you to retain some control of your money, but also gift it. And again, without getting into too much on that today, you need to have advice if you're going to think about putting some of your money into a trust for your family to help avoid inheritance tax for the future. So our approach is to use all of these things. We would make sure that we use trusts for things like your life cover. We'd make sure those are in trust. We'd make sure your pension benefits are in trust. We would use some of the gift exemptions that I talked about on the previous screen, but there are lots of different types of plans. Mentions there a discounted gift plan, talks about loan plans. There's lots that we can do. So if that's something that concerns you, it's really worth making an appointment. Okay, so drawing things together, we summarize by saying, look, there's so much that we can help you with. We haven't even talked about how, if you're in business, that we can help with how you make sure you're getting your dividends tax-free. If you're a business director, how you can shield yourself from the reduction in dividend allowance in the future. So we've really focused on personal taxation today, but that's something that we can really help with. So ISAs, vitally use it or lose it. Again, your pension, you need to use it this tax year or make provision for next year if you want to take advantage of all the things we've talked about. If you're worried about capital gains tax or inheritance tax, I think the final summary from me would be use your allowance now. and book an appointment now to see one of our advisors if you haven't already done so. So just thank you for your time today. I hope it's been useful. I hope you've had something in there that has made you think and maybe made you decide to come and see us. I would point out that anything we've talked about is actually subject to change next week, because as you're probably aware, on the 6th of March there is a spring budget and the Chancellor could make some changes. So we do plan to hold another webinar following next week's spring budget, just to bring all of our clients up to speed on the any changes that take place. So I'm going to hand back to Janine now. Thanks again for your time, and she's going to wrap up and talk to you about how you can make an appointment.
Brilliant. Thank you very much, Ian, and thank you everybody for your time today. As Ian said, we have focused really on personal tax today, but we are also experts in business owners giving advice there. So either way, we encourage you to get in contact with us, and you can see the contact details on the screen there. So you can email info@weareiq.com. You can also visit our website, which is www.weareiq.com. The phone number is there. And you will see in our socials and an email following this a tax savvy scorecard, which we're going to be sending out, and you can test yourself as to whether you're using your allowances. But as Ian said, it's very important to get in touch and book an appointment, especially with the end of the tax year looming. And hopefully we'll see you all again soon on our next webinar around the spring budget, which we will be having on the 14th of March. So please keep an eye on socials for that. Thank you very much, and have a lovely day, everyone.